Well, SpaceX fits the bill as well, down more than 30% in July,
Yeah.
trading around 112 right now. I heard you mention small caps. I heard you mention international. Talk to me about the other portions of the portfolio. What areas outside of tech look most attractive to you right now?
So to be provocative, I don't think the Fed hikes rates. I may be wrong about this, but let's assume as we go forward in the next few months here, we don't get a Fed rate hike. I mean, the only way that happens is a really a significant increase in the conflict between Iran and Israel, the United States, and so on, where we see oil up somewhere around 120 to $140 a barrel for an extended period of time. Much of what I'm telling you today will change. And for that reason, you want some defense in your portfolio. Not that international or small caps will represent defense. We could talk defense in a second. But if assuming that doesn't that happen, that's not my base case. Oil goes back to 70, $75 a barrel. But once there's a resolution in play for Iran. But the reason why I like small caps is I think we're in a deflationary world, not inflationary. I think the K-shaped economy, as well as technology, specifically AI, is deflationary long term, not inflationary. And why that's relevant, I think we do get back to a 2.5% inflation rate. But when you couple the productivity that AI does for small caps, plus the lower borrowing rate somewhere over the next 12 to 18 months, I think it's a great opportunity when you see earnings growth in the small cap space between 30 to 50%. So that's why I really like it. I don't think the U.S. consumer is stressed. The low-end consumer is a bit who spends in these places, but nothing of significance yet. Our labor force is quite strong. Again, big win for small caps. And when I think about that area, I just think it's a great way to diversify your portfolio. Look at the returns this year, more than double the S&P. And international's going to have no choice but to rebuild their defense with $2 trillion over the next 5 years. So I think it acts for a dividend play and a relative solid growth play, especially when international stocks still traded about a 30% discount to U.S. stocks.
As you're thinking about adding small caps and international exposure to your portfolio, do you get that through having to stock pick, or do you get that through index funds then that are a bit broader?
It's a really good question. I know many of your listeners, I don't want to make this alphabet soup. I absolutely prefer an index fund for those areas. Why? Because it's much harder to pick the winner and loser in small cap and international, especially small cap. Small cap is inefficient. What's that mean? More bankruptcies happen in small cap than people realize, more lack of success stories. And there are some big winners that push the indexes higher. And what happens is when a small cap stock gets big enough, it gets pushed up to another index. So by being in a index-based, actively managed ETF, I think it's a very smart way to win there. You don't have to try and decipher small cap earnings. It's much harder than large cap. And international, the problem with international, why I would use an actively managed ETF there as well, is because we know international has been a boring place to be for the better part of the last 10 years. Leaving last year aside, international has not been a win. Even this year, it's just tied with the S&P. So we're doing this based on a spending story, and why I'd rather see you buy an ETF rather than a stock, because the spending story hasn't developed yet. We don't know where the money is going to be spent exactly. Will some of it be spent in the United States, some of it overseas? What happens with Ukraine-U.S. partnerships in defense? Where does that become an area where Europe will spend? So there's still some unknowns. So the reality of the money being spent is why I like it. The not clear picture of how it's going to be spent is why you buy an ETF rather than individual companies.
Okay, bringing it back to the broader market, you kicked things off by saying you expect a volatile period. So how should investors know if that volatility is normal and just kind of part of the process? We know the market can't go up forever. And when should they start to worry?
Well, look, we're still up about 8% on the year, so it's not like it's a bad year. It's still a pretty phenomenal year for the S&P 500. Anytime you see a correction of 5%, I want you to take a pause. And the reason why, there's 5% corrections in every single year. There's usually one of 10% just about every year. So in that sense, the only time you have to really worry about a market washout is there's something unusual happen that's changing the market's momentum. And granted, right now with oil pushing up higher because of the latest conflict, with the Fed sort of being a bit of a unusual place, and that the Fed chair saying one thing and there's some dissenting by the Fed members, so that could create it. In a scenario where we had the Fed raise rates and oil over $100 a barrel, that's going to cause a 10% correction instantly. That would be a really tough day. But remember, seasonality matters. Traditionally, August is a pretty tough month. We're not quite there yet. And September is even harder. So you got one seasonality. This time of year is always very volatile as we take a hard look at the fourth quarter and what's going to be the best winners in the fourth quarter. And then beyond that, I just think you have this problem right now where we've had great markets for many, many years. We still have strong earnings. Look, you have over 20% earnings growth for the S&P 500. This is incredible. Margin growth on the S&P 500. How much companies make? If you run a company and you make 10 cents on the dollar, that's a really good year. Well, guess what? We're talking 15 cents on the dollar. So you're looking at incredible earnings growth for the average company out there. Incredible just profit growth for companies out there. So in that kind of time period, you rarely get corrections of 10, 15%. So a 5% correction is a chance for you to reevaluate, look where we are, look for those names like you've mentioned already, great names that are down a lot. I don't think you worry so much about the broad market. I think you worry about what's that name you always wanted to buy. Is it finally cheaper, like we opened with, and that's where you focus your attention.
Okay. And over the next 6 to 12 months, volatility aside, do you think this is a market that will be higher than where we are now?
And that's an excellent question. So I don't know if you're going to like my answer. The return back to normal is something that I think folks have to be prepared for. You see, folks, we've been living in a bit of an abnormal world for the past 10 years with returns on the S&P between 13 and 14% on average. I don't think that continues. And the reason why I don't think that continues is government spending is being culled in domestically, internationally. We're not spending prolifically the way we did post-pandemic. Earnings growth, while quite strong, has to help prices equal the amount companies earn. If you look at the P divided by the E, price to earnings ratio, we're starting to get back to somewhat normal earnings momentum. And that means probably something like 16 to 18 times earnings on the S&P, not 22. So what does that mean? Probably average S&P 500 growth of 6 to 8% over the next 12 months, not 30. And I think that's where some folks get caught up on. Give me one caveat, one little caveat, that the third year of the election cycle is usually the best year of the S&P 500 of the 4-year presidential cycle. And at a time when more than likely the House and Senate will flip one, two, maybe both, it means not a lot of things are going to change in the years after the midterm. The market likes that. So in a scenario where there's not a lot of change and we continue to get solid earnings growth, you could do a bit better, 12 to 14% on the S&P next year. But I want you to have the expectations of more of around 8.
All right, so it might be a roller coaster and we might get right back to where we are right now.
Yes.
I think this is a great place to pivot to our rapid fire game of this or that. Quick questions, quick answers, no hedging. Okay. I know this is your first time playing with this, Phil. Are you ready?
I can't wait. I'm excited.
All right, here we go. Stocks by year end, higher, lower, or flat?
Flat.
Second half, optimistic or cautious?
Cautious.
Stay invested or raise cash?
Stay invested.
Pullbacks, buy them or fear them?
Buy them with both hands full of cash.
Add risk or play defense?
For now, defense.
Market leadership, broadening or tech comeback?
Broadening.
Tech sell-off, opportunity or warning sign?
Opportunity.
Semiconductors or software?
Ooh, semiconductor.
Software name you would buy here?
Salesforce.
AI builders or beneficiaries?
Builders.
A builder that's a must own?
Maztec.
A beneficiary that's a must own?
Western Digital.
Small caps or large caps?
Both. That's a terrible answer. Small cap.
Western Digital or Nvidia?
Western Digital.
One sector you'd avoid in the second half of the year?
Staples.
One sector you'd buy?
Discretionary.
One stock everyone will wish they bought by year end?
Encino. NCNO.
Finish this sentence. I would turn bearish on the market if...
Oil goes above $120 a barrel.
All right, we'll leave it there. Phil, really appreciate you joining us. Thanks so much.
It's a lot of fun. A lot of fun. Thank you so much for having me. I really appreciate it.
That's Phil Blancato of Osaic. If you enjoyed this Street Talk, check out our full interview with Liz Thomas. She says the S&P 500 has not peaked yet and shares the sectors to buy now.